Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We are Central Florida's longest-running radio program, coming to you on a host of radio stations throughout Central Florida. We are also one of the top 25 financial planning podcasts in the world, with over 40,000 downloads of our program. Be sure to subscribe to our channel on your favorite social media and podcast platform of choice. If you have any trouble finding us, just go to our website, nelsonfinancialplanning.com, and look in the upper right-hand corner. Click on the icon that looks most familiar to you, and you will be instantly connected to our channel. So my name is Chet Cowart. I am a certified financial fiduciary at Nelson Financial Planning. I am here with Kristin Castello, also a certified financial fiduciary at Nelson Financial Planning, where we stand ready to help you change your life this week with a successful and cost-effective financial plan with superior investment results. And we are here with some more tax changes. We were going through a lot of them before the break. Only got through about half of one before the break, so we're going to pick up right there. Kristin, where were we right before the break?
So we were talking about Form 1099-K. So this is a form that reports payments that you receive through online payment platforms like Venmo, PayPal, Square, that sort of thing. So we were talking about, what do you do if you receive one of these forms for a personal item that you sold actually at a loss? So before the break, we were talking about an example of Chet, who sold his car at some point on Facebook Marketplace. So it was sold at a loss, so he purchased the car for more than he ended up selling it for years later. So what do you do in that circumstance? So if you receive a Form 1099-K from one of these payment platforms, and it is at a loss for a personal item that you sold, what you'll do is you'll still report it on your tax return. So, for example, last year I sold some old home improvement stuff that I ended up buying, and I had extra paint, so I sold the paint. Purchased it for $150. I sold it for $50. So it was obviously at a loss, so $100 loss. Now, personal losses are not deductible on your tax return, but because I sold an item through one of these payment platforms, I may receive a Form 1099-K for that transaction. Mm-hmm. So what I will want to do is, if I get that tax form, I'll report that I received $50 of proceeds from selling the paint. I'll say that I paid $150 for it, and then on the tax return, net that out to zero. Mm-hmm. So essentially, it's a tax-free transaction because it was at a loss. But because it was a personal loss, I can't actually deduct the fact that I lost $100 on the transaction there.
Right. It's not saving you in taxes. You're just not paying taxes on it. It's yeah, exactly.
Right. So the main thing for everybody to watch out for this year is to double check all of these platforms and see if you have a tax form from it. And if you did receive one and it's an error, so if it's for Venmo and all you do is reimburse your family or they reimburse you, just number one rule is don't panic. So the first thing that you're going to want to do is make sure that you keep the tax form and report it on your tax return. So the number one thing that the IRS can easily red flag is if there's a tax form that doesn't line up with your tax return. So if they see a 1099-K for $600 and they don't see that $600 on your tax return somewhere, even if it nets out to zero, if they don't see that initial $600 somewhere, then it's going to flag the IRS and you'll be receiving a letter from them. Mm-hmm. So I can't tell you how many IRS notices I've seen that are just automatically generated like that because the person accidentally missed a tax form. And now that the 1099-K threshold is so low, I feel that we're just going to see more and more of these automatic letters that are sent out. And unfortunately, there's not too much you can do about them other than make sure you report all of your income on your tax return.
Right. I mean, a lot of people forget that, when you receive a tax form in the mail from one of these companies, you're not the only person getting it. It's going to the IRS as well. So you're much better off, whether or not you have a good reason for it, you deduct it, you have, your cost base is higher. It doesn't really matter what you do with it. It's better to at least report it than not, because the IRS will know about it regardless of whether you try to hide it or not.
Exactly. Yes. Yep.
So then going forward, there's some tax change number 8. There's some interesting things becoming available for in regards to employer matches on simple and SEP IRA plans. So get into that a little bit. What does that look like? Mm-hmm.
So our 8th tax change has to do with the fact that employers are now able to offer Roth Simple and SEP IRA plans for both employer and employee contributions. So this means that employees can now decide whether to take employer matching contributions on a pre-tax or on a Roth basis. So this really does depend on if the employer plan offers it. So it's not going to be every plan, but if your employer plan does have the capability to offer Roth contributions, then you have the option to switch your employer matches to that Roth basis. So this is part of the push for Washington to have more Roth money coming in. Roth money means that you are paying taxes on it now. So it's a good way to raise tax revenue in Washington. And I mean, we're fans of the Roth, especially if you're younger. So it's a good option for a lot of employees.
Absolutely. It always comes back to the government wanting their taxes now. It's the same reasoning for the Benny IRA 10-year rule and all of the other rules regarding them wanting their tax revenue right now and not later.
Right. So something to keep in mind, if you do change your contributions from pre-tax to Roth, so let's say you are maxing out your 401k or something along those lines, if you were previously doing pre-tax and you switch it to being 100% Roth, that will increase your taxes for the year. So you were previously getting a tax deduction, and now you are not getting that tax deduction. In fact, you're actually paying taxes on those contributions. So something to keep in mind. We see this from time to time when clients just accidentally switch 100% from pre-tax to Roth, and then they get a pretty big tax bill come tax time. So generally there's a kind of a good sort of sweet spot between there where you do a little bit of pre-tax, a little bit of Roth, just to kind of counteract the effects of each of them.
Right. I mean, when you're getting this money on an after-tax basis, it's great for a lot of reasons, but it is easy to forget that it is money coming to you that taxes have been paid on. So it is income to you, and yes, important to remember so you're not surprised on your tax return.
Yeah. And we help clients with that all the time here. So trying to figure out how much they should do on the pre-tax level or on the Roth level, depending on their specific income circumstances. So not everybody's tax return is going to look the same. So we want to make sure that we're doing what would be the best strategically for them.
Right. It's not the same exact shelter of income that a traditional retirement plan would be. It functions a little bit differently, and while it may benefit you later on with all of that tax-free growth, it is going to affect you in the short term a little bit. So something to think about. And then, so another change going forward, qualified charitable distribution and annual gift limits increase. So this one's pretty simple. The QCD amount has increased from $105,000 to $108,000 in 2025. That is on a yearly basis. It's linked to inflation, so it's expected to increase every year going forward. And then the annual federal gift exclusion has increased from $18,000 in 2024 to $19,000 in 2025. So just a nice little boost in terms of what you can give to others, as well as what you can give to charities and churches, nonprofits, that sort of thing. A good little boost. A lot of our clients take advantage of those QCD benefits, and I think this will help and affect a lot of people.
Right. And always keep in mind that when you gift something, it is not taxable to you or the recipient. So if you gift over these limits, that just means you have to file a gift tax return, but it still does not necessarily mean that it's going to be taxable to either you or the recipient.
Right. Important to remember, I get that question a lot, is how much I can give on a yearly basis without paying taxes, and people, that's just a filing and reporting limit. It's not a tax limit. So in reality, you're fine more than likely most of the time.
Yep. And then the last tax change we have here, so number 10, this is one that actually benefits everybody. So we have a small decrease to the underpayment tax penalty. So kind of what this is the U.S. utilizes a pay-as-you-go approach, meaning the IRS expects you to remit taxes throughout the year based upon your estimated income. It's typically done through W-2 withholding if you're an employee, or quarterly payments if you're self-employed or if you're retired. So now this penalty has gone down from 8% down to 7%. So it's still pretty high. 7% is still a hefty penalty, but it has decreased. So that is good news for individuals out there.
Absolutely, yeah. A lot of our clients are or should be making quarterly payments, and this is a good thing for if you happen to miss that quarterly payment. The IRS does expect you to make them throughout the year, especially if you don't have a typical job where you're paid on a W-2 basis and the withholding is given or withheld throughout the year. They expect you to pay. So a good little boost. You don't have to pay them as much when you miss that. Sure. So, yep, those are our top 10 tax changes for the year. This has been Chet Cowart and Kristin Castello with Dollars and Cents, Nelson Financial Planning. We are here to help. We have no account minimums. We give consultations at a no obligation basis. Don't hesitate to reach out and contact us for help with any of these tax changes, as well as anything regarding your finances. Visit us at www.nelsonfinancialplanning.com, and we have a whole host of ways to get in contact with us. Once again, this has been Chet Cowart, Certified Financial Fiduciary, Kristin Castello, Certified Financial Fiduciary at Nelson Financial Planning.